The Finance Bill 2020 was signed into law by President Muhammadu Buhari on the 31st of December 2020 and came into effect on the 1st of January 2021. Significantly, the new law introduces over 80 changes to 14 different laws that will affect all concerned. The key changes include exemption of low-income earners earning 30,000 naira per month or less from personal income tax, meaning no pay-as-you-earn on their salaries. Unclaimed dividends in a listed company and dormant account balances unutilized for 6 years or more are to be transferred to the Unclaimed Trust Fund, which will be managed by the Debt Management Office. The amounts can subsequently be claimed by the owner at any time together with the yield. The Act also expanded the scope of items liable to excise duties to include telecommunication services provided in Nigeria. There is also the reduction of import duty on tractors from 35% to 5%, mass transit vehicles for transport of more than 10 persons, and trucks from 35% to 10%, and reduction of import levy on cars from 30% to 5%. The new law indicates that land and buildings are not taxable goods for VAT purposes, meaning there is no VAT on transfer of land or purchase of a building. This also suggests that no VAT on the rent of property. The Finance Act 2020 also provides for the exemption of commercial airline tickets from VAT.
The broad principle is to consider how we will have adequate macroeconomic strategies to attract investment, to be able to grow the economy on a sustainable basis, but also to create jobs as the immediate fiscal strategies that we need to put in place to accelerate domestic revenue mobilization in response to the COVID-19 pandemic and the recent decline in the economy.
President Muhammadu Buhari, upon signing the 2020 Finance Bill into law, stressed the importance of the new legislation to the successful implementation of the 2021 budget of economic recovery and resilience. He went on to say that in designing the 2021 budget, there was a deliberate choice to pursue an expansive fiscal policy given the challenges posed by the COVID-19 pandemic and the subsequent slide into a second recession. The intricacies and implications of the Finance Act 2020 will be the issue up for discussion shortly.
So Albert Falonshaw, who's a business and tax advisory expert and one of the backroom hands who helped work on the Finance Act 2020. Mr. Falonshaw, give us an insight into what the issues were in terms of consideration for the provisions that we now have in the Finance Act 2020. What is it that the government was looking at, and how the consultants and other players weigh all of this before reducing it into a draft bill?
Well, thank you very much. You will recall that in 2019, there was the Finance Act, which was coming 30 years after the last one was done in 1999, I guess. Okay, so the 2020 Finance Act is just a follow-up on the 2019 Finance Act. The 2019 Finance Act looked at all the outdated laws, okay, and also brought in a number of new provisions, okay, which was to stimulate the economy. We have the REITs, Real Estate Investment Trust provision. We have the security lending provision, and a couple of others like that, which were meant to revigorate the capital market and that. So this 2020 Finance Act is just to build up on that and to cultivate a culture of reviewing our law on a regular basis so that it can be in tune with the time, with the economy. And so this year, certain changes were made to those that were made last year in 2019. And of course, a couple of other sectors were reviewed. The agricultural sector, there are provisions. The issue around minimum tax provision was made because of the way the public also viewed the one that was promulgated in 2019. And so that was just the basis to ensure that, and to also facilitate FRS, Federal Revenue Service, and the tax authorities work by giving them the the right to deploy proprietary platform and technology in order to enhance the activities of the Revenue Authority. So those are the platform on which this 2020 Finance Act was built.
Mr. Abba Folonshaw, I want to assume that perhaps it's your manner of speaking when you say that the 2020 Finance Act was just a review of the Finance Act 2019. Certainly the implications and therefore the consequences of the Finance Act 2020 are far-reaching. There's no question about that from what some analysts and experts have indicated. So what were some of those outdated laws that some of the backroom hands needed to consider, and why was that consideration? And at a time when the government is saying, listen, we are cash strapped, we're also seeing a reduction in what some persons would regard as viable sources of revenue.
Well, from what the minister have said, you in a situation of recession, okay, the trust was to ensure that no new taxes, okay, were promulgated, and that not too many reliefs or incentives were included, so that the government will be able to fund the 13.8 trillion budget, okay. And so, if you look at the minimum tax, the question was, why should companies be paying minimum tax on their turnover and not on their profit? Okay, and there are quite a number of companies that whose turnover, whose margin on their turnover is so thin that assessing them to tax on turnover was considered excessive. And so government looked at that and then reduced the rate from 0.5% of turnover to 0.25% of the turnover. Again, if you look at the provision on capital gain, which is not too elaborate, it just was to correct a minor error or misconception around the provision relating to compensation for loss of office, so that it will be known that it is only where the compensation is above 10 million that the capital gains tax will apply. Okay, if you look at the provision of CETA in section 11, it brought about incentive to banks so that they can give out loans to agricultural companies. Okay, and so it reduced the moratorium from 18 months to 12 months, and also ensure that the rate of interest is still on the base lending rate at the time the loan was granted, refinanced, or restructured. A couple of other provisions, was made in that line, including the VAT provisions, okay, which now reduce or remove VAT on rent, like you mentioned, so that VAT will specifically be on goods and services, and of course intangibles or intangible that are owned by companies. So those are some of the provisions that has been made. I'm sure you know from the background information you gave, a whole lot of provisions were made.